All right, welcome back, people. We are going to start with this thing which we call as revisions, people. Yes, you call it revision, you call it marathon, no matter what you call it, it means the same. We are going to start with this quick revision, people. I am also going to be uploading this on YouTube. So if at all you kind of sleep off right now, you will always find it on YouTube. Yes, revision and marathons are basically with a very simple intention. It's not that I'm going to be discussing any concepts with you. Yes, we have already dealt through that in detail. You already have the lectures available with you. You can always go and watch the lectures once again. The idea behind a revision or a marathon is very simple, people, is that sometimes a person can get overwhelmed with the kind of syllabus and the content which you have. Yes, revisions help you with a very simple intention that when you go the day before exam, the topics which you think you will spend more time on, the topics which will take extra time for you to read yourself, you can always watch these revisions together. Yes, so that I will be completing the topic a little faster. If you match my speed, your syllabus gets done faster, right? And so it helps you more in your 1.5 days ka preparation. That is what the whole ideology behind this thing is. Revisions also helps you in case there are certain topics which you don't understand. You can go through these lectures quickly and then try solving some sums. Okay, let me clarify this once again. Revisions are not a replacement of your main course. Yes, we will not be discussing any logics behind any concepts. Intentions of the revisions are going to be twofold. I'm going to be not going through the whole subject. Yes, as in I will not be taking through the whole chapter one by one and telling you each line. I'll be discussing about those important points which you should be focusing from your exam perspective. You'll be marking those points in case you have not marked it earlier. I will also be at appropriate times telling you that this is something which you need to keep in mind and this is what you may miss out, so that you note those things and you keep that in check. That's what the whole idea behind any revision lectures are. Is that clear for everyone? Yes, we're going to go from the start, people. What we're going to do is we're going to complete your module number 1. We're going to complete your module number 1. They're going to take a pause. We're going to take a pause. We will directly then jump to comprehensive questions. Yes, we'll then jump to comprehensive questions because your comprehensive questions will be compilation of your module number 1. We will complete all your comprehensive questions, thereby finally completing our syllabus, and then we will come back and we'll do module number 2 ka revision. Yes, ideally module number 2, people, the revision is going to be very limited. There's not much to discuss. There's just non-residence, non-surprising, probably your double taxation relief and everything. So the topics in module 2 are fairly lower and fairly easier to complete. So module 1 complete revision, sums, and then module 2. That's what the whole idea practices. Yes, my small request today, people, please have your module 1s open with you. As I keep going through the topic, you will also keep going through the topic. You will try to recollect everything we discussed in the classes. You'll try to recollect everything we discussed in the classes. You'll try to memorize what we have been discussing right now. If you have not marked something as important which I tell you is important, please mark it then and there and start highlighting those things which are making more sense to you. Is that clear for everyone? Yes. Module 1, I'm quickly showing you, people, what and all are we going to discuss in module number 1. We're going to be starting with your basics. Then we're going to start with the basics. Then we're going to go into your computation of total income. We're going to go into your computation of total income, and then module number C, this button. Yes, and then we're going to question number C, people, which is talking about assessment of various entities. This is what the whole idea practices. Ideally, for your comprehensive questions, we only need module part B. People. If you're done with your PGBP and capital gains, we're technically done with your comprehensive questions. But good exercise to also complete various entities, because some piece of partnership firm and everything will also keep coming there. So we're going to do that as well. Yes. So 3 parts we're going to be discussing in your module number 1, people. That's what the whole idea practices. Are we good to go? Yes. At appropriate stages, people, if you get stuck somewhere, if you think this is not touching your memory properly, just stop me there and I'll explain it once again. But again, no expectation of detailed revisions. Anything which is going to take more than 5 minutes, I will ask you to check back your old lectures. Is that clear? Yes, great. We're going to start with your module number 1, people, part number 1, which talks about your basics of income tax. Nothing much to understand in this chapter except for a couple of things. First is that if you want to have a tax under India, you have to be article number 265. You have article number 265, which talks about the fact that taxes in India will be collected only by the government of law. Any act will be created under article number 246, where there are 3 lists. One is union list, one is state list, one is concurrent list. Union list covers all your central income tax, except for one income tax which is called agricultural tax, which forms part of state tax. In income tax, agricultural tax is partially integrated. Agricultural income is exempt from taxes. That is what is to be kept in mind when it comes to your attempt, people. For assessment year 25-26, you are looking at Finance Act number Finance Act number 2024 and Finance number 2 Act of 2024. 2 acts for you to read. Like we discussed earlier, Finance number 2024 does not have much. Finance number 2 has the major amendments of it. Things to be kept in mind from your circular perspective when it comes to circulars and notifications. Which one of this is binding on assessee? Notifications is binding on assessee. Which one of this is binding on department? Both are binding on department. Which is only binding on department? Circulars are only binding on department. MCQ question number 1. Circulars are binding only on department. Notification is binding on both assessee and department. Yes. Then we have other things, people. First things is, what do you mean by capital receipt and revenue receipt? We already discussed. Items which are done regularly is revenue receipt. Items which are done once in a while is capital receipts. Items from which you generate revenue is revenue receipt. Items which are used to aid revenue is capital receipts. Items which help on your bread and butter, which if lost will impact your bread and butter, is capital receipts. Items which are not going to impact your bread and butter is revenue receipts. If you are dealing in shares, it will depend on whether you are trader in shares or non-trader in shares. If you are a trader in shares, it is revenue receipt. If you are not a trader in shares, it is capital receipts. Some case laws which we have discussed, people. First is that if you are entering into a technical collaboration agreement for a JV, and the agreement is designed only because of which a JV will come into existence. Tomorrow, if the agreement is rescinded, the JV will also stop. In that case, whatever compensation you get for that agreement will be capital receipt, because the entity will stop functioning. Second, if you are going to receive any kind of liquidated damages for a delay in procurement of assets, you have requested for a capital asset and the asset has not come on time, for which you have got punitive damages, liquidated damages. These are all capital receipt because it is relation to your capital asset. Third, any kind of foregoing a security deposit to settle a dispute. Is also treated as capital receipt. It's not something which you'll do on a regular basis. So foregoing a security deposit will also be called as a capital receipt, negative capital receipt, or as we call it, capital expenditure. This is what the rules of thumbs are when it comes to your case laws. Yes or no? Yes. Like we discussed earlier, people, if there is a theoretical case law, that is what you need to read from exam perspective. If it's a practical level case law, then it will come more for your compulsory questions. So that's why we are not spending too much time on this. We are looking at more from compulsory question perspective. Yes. Then how do you compute taxes, people? You will have to compute tax in the assessment year for the income earned in previous year. Previous year may or may not be for 12 months. Assessment year is always for 12 months. Previous year will not be for 12 months in case where newly starting business or a person has first time come into existence. 5 cases where previous year and assessment year will become the same. Non-resident shipping company leaving India, dissolution of AOP BOI created in the year, dissolved in the same year. Then business or profession discontinued in the year. Then person leaving India with no intention of coming back. And finally, sale, disposal, charge of an asset with an intention to evade taxes. We discussed the Vijay Mallya case, people. Yes, please keep that theoretical question in mind. This ideally is more tested in inter level, not at final level, but good enough to know. Yes, this is what your chapter number 1, which talks about your basics. Good enough to go? Yes. Moving on to chapter number 2, people, the important chapter from your exam perspective. We are looking at tax rates. People, as we discussed tax rates, I told you, when it comes to tax rates, you have to split yourself into persons first. The first person, more for inter, less for finals, is called individuals. Under individuals, people, you have 2 regimes. One is default tax regime, alternate tax regime. In a question in exam, if they come and say if he wishes to go for default tax regime, you'll do default tax regime. If a question wants alternate tax regime, they'll say he decides to opt out of default tax regime. Then you go for alternate tax regime. We are under alternate tax regime, people. Income tax is when you are under alternate tax regime. Tell me what you are. If you are a resident aged below 60 years or any non-resident, you will have a slab of 0 to 2.5 lakhs at 0, 2.5 lakhs to 5 lakhs at 5%, 5 lakhs to 10 lakhs at 20%. After 10 lakhs, it is 30%. If you are a resident person with an age more than 60 years at any time during the previous year, then the slab becomes 0 to 3 lakhs 0, 3 lakhs to 5 lakhs 5%, 5 lakhs to 10 lakhs 20%. After that it becomes 30%. Please bear in mind, when you say the word anytime, it means if your birthday falls on 1st April, you have completed 60 years on 31st March. You have completed 60 years on 31st March. That is what the rule is. If you are a resident person who's aged more than 80 years, then it becomes 0 to 5 lakhs 0, 5 lakhs to 10 lakhs 20%. After that it becomes 30%. Then it becomes 30%. If you are under alternate tax regime, people, you can categorize yourself into 3 buckets. One is rich, poor, middle class. Rich, poor, middle class. What we discussed right now will be your middle class answers, on which you will add health and education cess at the rate of 4%. If you are ending up being a poor, income tax says you are a poor if your total income is less than 5 lakhs, in which case you get a rebate of 12,500, or actual tax payable, whichever is not eligible for 112A long-term capital gains. 112A long-term capital gains. But if you end up becoming a rich person, you are liable for surcharge, where if you are up to 50 lakhs, it is no surcharge. 50 lakhs to 1 crore, it becomes 10%. 1 crore to 2 crores, it is 15%. 2 crores and 5 crores, it becomes 25%. And then 5 crores ka becomes 37%. These 25 and 37 surcharges will not apply in case you are having incomes from capital gains, 112, 112A, 111A, dividend income. These 4 incomes will only be liable for a surcharge of 15%. Because of these incomes, other incomes cannot be charged 25 and 37. If your total income is more than 2 crores, you have to minimum charge 15%. If your total income excluding these incomes are more than 2 crores, then it is 25. If your total income excluding these incomes are more than 5 crores, then it is 37%. We did some examples, people. This is what the chart looked like. Yes or no? Yes, yes. Then, people, we moved on forward to something called default tax regime, where default tax regime says the tax slabs are 0 to 3 lakhs 0, 3 lakhs to amendment of current year 7 lakhs 5%, 7 lakhs to 10 lakhs 10%, 10 lakhs to 12 lakhs 15%, 12 lakhs to 15 lakhs 20%. After 15 lakhs, directly 30%. There is no 25, directly 30%. Then if you are under default tax regime, you will be called poor if your total income is up to 7 lakhs, giving you a rebate of 25,000, or actual tax payable, whichever is lower. If you are a rich person, you will be liable for surcharge at the rate of 0 to 50 lakhs 0, 50 lakhs to 1 crore 10%, 1 crore to 2 crores 15%. After 2 crores, directly 25%. We don't have a 37% surcharge. Again, people, 25% will not apply in case 112, 112A, 111A, dividend income. These 4 incomes will not apply. Maximum surcharge on this 15%. If you are having a surcharge, if your total income is a little bit more than the slab, because of which the surcharge is changing, you can claim something called marginal relief. How do you compute marginal relief, people? You will compute tax on actual income, then you will compute tax on the nearest limit. Difference of tax will be compared with difference of income. If your difference in tax is 5 lakhs but your difference in income is 1 lakh, you will say, I am getting a marginal relief of 4 lakhs. I'll give you a marginal limit of 4 lakhs, and then you will add cess on it and get the final answers. This same concept is there for marginal rebate, only for default tax regime. If your income is somewhere around 7,26,000, you will be eligible for a marginal rebate only under default tax regime, cannot claim it under alternate tax regime. This is what the rules are when it comes to default tax regime. Clear? Yes. Then we went on forward, people, to other people. We went on to the first person called as firm, where the tax rate is 30%. After that, if you are found to be a rich person, then the tax rate will have a surcharge at the rate of, if your total income is more than 1 crores. Very good, more than 1 crores. No special regimes for firms, people. This is the only regime available. Then you have someone called companies. Which gets split into 2 categories. One is domestic company, one is foreign company. Domestic company, you'll have to check a previous year of 2020. I told you people, whatever year you have 2 years back, so leave last year, last year. You are in 24, 25, so ignoring 23, 24, 22, 23. If your previous year 22, 23 turnover is up to 400 crores, you can get a tax rate of 25%. If you are more than 400 crores, you get a tax rate of 30%. If you are a foreign company, current year amendment, mandatory question and exam, foreign company tax rate becomes 35%, mandatory tax rate of 35%. Expect a question in current year for foreign companies. If you are under domestic company, you also have something called special regimes. Two regimes given to you, 115B AA, 115B AB. 115B AA comes and says you can have a tax of 22% with a surcharge of 10% with a cess of 4%, making it 25.168. If you are under 115 BAB, you'll have a tax rate of 15% with a surcharge of 10% with a cess of 4%, giving to 17.16%. You'll get a surcharge total effective tax rate of 17.16%. Although people, when it comes to 115 BAB, there are some other rules. Let's hold that rules discussion right now. Yes, if you're not opting for these regimes, people, if you're under 25 and 30%, normal surcharge rates are 0, 7, 12, foreign company 0, 2, 5, 7 and 12 in case your total income is more than 1 crore, less than 10 crores. If it is more than 10 crores, then it is 12%, then it is 0, 2 and 5, 0 to 1 crore, no surcharge, 1 crore to 10 crores, 2%, after 10 crores, 5%. Like I clarified earlier, people, surcharges are not slabs. The moment the income goes beyond that limit, surcharge will apply on the total basic tax, Clear, not clear? Yes. After you're done with your domestic company and foreign company, people, you have something called as cooperative society, where the limits are for the first 10,000, 10%, after that 20%, after that directly 30%. Same cooperative society has the same regimes as companies, and therefore we have 115BAD and 115BAE. 115BAD talks about 22%, 115BAE talks about 15%. Same rules apply as companies. Yes, after you complete all that, people, you will have your special incomes. Which are going to be taxed at a special rates. Mandatory question in exam, you have capital gains. Income tax says in the current year, if you have capital gains, tell me when the transfer took place. If the transfer took place before 23rd July, then it is old rates. If it is on or after 23rd July, it is new rates. Before 23rd July, LTCG under 112A will get a tax rate of 10%. After 23rd July, 12.5%. 112 will have 20%, 12.5%. 111A will have 15%, 20%, 15% and 20%. 112A gets a overall basic exemption limit of 1.25 lakhs. Like we discussed in class, people, this 1.25 lakhs can be reduced from any capital gains, whether it is before 23rd July or after 23rd July. If nothing is given in the exam, assume to remove from after 23rd July to get the maximum tax savings. If you are moving on forward, people, you have something called casual income. Casual income means lottery, betting, gambling and all those things, taxed at the rate of, without allowing any expenses, losses, deduction, basic exemption limit. Yes, then we have online winnings, people. Online winnings are also taxed at 30%, but to tax online winnings, you need to use a formula which is closing balance minus opening balance plus withdrawals minus non-taxable deposits. Please ensure the final answer of this is always positive. If the number comes negative, ignore answer. You will tax nothing, you will give no losses. That is what the rule is. Then you have transfer credits from carbon, people, which is also taxed at the rate of 10%. Unexplained income is taxed at the rate of plus mandatory surcharge of 25 plus cess of 4%. Then you have royalty on patents registered in India at 10%, people. 115 BBF, where they have come and said if you want to claim this royalty at 10%, you will not be eligible for your 80 QQB and RRB. You should have completely done the whole expenditure in India up to 75%. Invention should be registered in India. And you should opt it for next 5 years. If you are not doing that, then you have capital gains on virtual digital assets, which are taxed at the rate of 30%. Rules of taxing same as capital gains, same as capital gains. For all these things, people, rules are as follows. When you have special incomes other than capital gains, can you claim expenses? No. Can you claim losses? No. Can you claim set-offs? No. You can only claim these for capital gains. Can you claim Chapter 6A on special incomes? No. Can you claim Chapter 6A on capital gains? No. Chapter 6A is not eligible for any special incomes. Chapter 6A not eligible for any special incomes. If your basic exemption limit is not utilized by slab rate incomes, can you utilize your special incomes? No. Only capital gains. That too if you are a resident individual. That too if you are a resident individual. We discussed this as gulab jamun and kaju katli. Yes. If you have gulab jamun and kaju katli, you can use it only for capital gains, not for anyone else. That is what we discussed. Surcharge rates for all special incomes will be same as slab, except for capital gains, which will restrict at 15%, except for unexplained income, which will restrict at 25%. That is what the rules are when it comes to taxabilities. Things to be marked here which you may forget and you may miss out. First is deduction under Chapter 6A is not claimable for any person. Deduction under Chapter 6A is not claimable for any person. Second, you can claim basic exemption limit for your capital gains. You can claim your basic exemption limit for your capital gains. We have done some healthy level questions, people, as we started the batch. Please go through that questions in case you don't understand this carefully. Yes, but please pay attention to this one. Clear enough, people? Any doubts? Are we good to go? Can we? Yes. This is your chapter number 2, which talks about rates of taxes. Moving on to your chapter number 3. Before you start, people, one thing which you should have primarily understood by now, when you are going to compute a total income, please round off to nearest 10. When you have a tax payable, please round off to nearest 10. Doing this carries half of mark each. You cannot make this mistake. Yes. Then you move forward, people, to something called a special tax regime. Like we have already started discussion on this. 115BAA, 115BAB, 115BAC, BAD and BAE. 115BAA talks about your domestic companies having no conditions, tax at the rate of 22% with a mandatory cess of 10%, with a mandatory cess of 4%. If you are going to go 115BAB, then now the rates will change a little bit, people. Normal manufacturing entity having incorporated after 1st April 2019, but before 31st March 2024. Will be eligible for 115BAB at the rate of 15%, 10 and 4 in case you are having manufacturing operations at the rate of respective rates of special incomes if they are going to tax accordingly, but surcharge will mandatory be only 10%. If you are going to have in short-term capital gains on which no depreciation is allowable, then it is 22 plus 10 plus 4, which is 25.168. Give me examples on this, people. You are looking at land and goodwill. Other than on which no depreciation is claimed. No, it should be a depreciation claimable item first. Yes, so you're looking at land and goodwill. If short-term capital gains are arising from land and goodwill, then that is not eligible for 15% rates. It's eligible only for 22%. If you're having short-term capital gains on shares and all, which is 111A, that is automatically respective rates. Yes, then you have income which are neither derived nor incidental to manufacturing process or generation. Basically all incomes which are taxed under HP or other sources, those will get taxed at 22, 10, 4. But the rule here is that you will get taxed at 22% without allowing any expenses or deductions. They're going to be taxed at gross level. Finally, if you are going to have a person which is going to be transacting with a connected persons in such a way that the profits are unreasonably high, or you have excess profits, you will then be taxed on those excess profits at the rate of 30% with a surcharge of 10% and a cess of 4%. That is what happens. Yes, if you are going to have excessive profits by AO, then it is 30 plus 10 plus 4. Conditions to be followed when it comes to 115BAB, people, that you should not use any old plant and machinery more than 20% of the total value. Business should not be formed by splitting up or reconstruction. You should have not claimed any deduction of building under old laws of 80ID. You should not be engaged in the following businesses like developing computer software, minings, marble blocks, bottling of gas into cylinders, printing of books, etc. Yes, these items should not be done for you to claim 115 BAB. When you are claiming for 115 BAB and BAA people, you need to ensure that when you opt in, you will always remain in the same regime. You will always remain in the same regime. You cannot opt out unless assessing officer feels that you have contravened any laws. Unless and until assessing officer feels you have contravened any laws. If assessing officer feels you have contravened a law, he will move you out, and the moment he moves you out, you can never opt for the same section. You can never opt for the same section. A person who is denied 115 BAB can choose 115 BAA. Can choose 115 BAA. A person who is denied 115 BAA cannot choose anything. Cannot choose anything. Will directly go to normal tax rates. Will directly go to normal tax rates. That is what the rules are. Yes, that is what it is. When you choose 115 BAB people, you will have to ensure that the return is filed within the due date on the first year itself. On the first year itself, if you are choosing 115 BAA, you can file the return whenever you want. You can file the return whenever you want, but when you file the return for that year alone, you will be eligible. After that, you can claim for the next years. After that, you can claim for the next years. If you delay in filing your returns, you will lose the eligibility for that year. You lose the eligibility for that year. You will only be able to claim it from next year. That is what the rules are. Items which are denied to you when it comes to 115 BAA and BAB people, we will hold this discussion. We will discuss it along with the respective incomes. We'll discuss it along with the respective income heads. Yes, so let's hold this discussion right now. We are then moving on forward to 115 BAC people. Tax rates already discussed, rebate already discussed, marginal rebate is discussed with you, surcharge is discussed, marginal relief is discussed. Please note carefully that when you're choosing for 115 BAA or 115 BAB, you don't have to compute MAT. When you're choosing for 115 BAC, you don't have to compute AMT. That and all is not taken. Two special benefits given in the current year people, and I expect a question on this in exam in your double taxation relief, is that if you are choosing 115 BAC, if you are choosing 115 BAC, any salary will be now granted a standard deduction of 75,000 under default regime, but only 50,000 under alternate regime, So please be very mindful about this. If you get a double taxation question, check whether what regime is opting for, and then check whether salary is given in the question or not. If salary is given, then it is 75,000 for default and 50,000 for alternate. Yes, keep that one thing in mind. Keep that one thing in mind. Then after you go for 115 BAC people, we are then moving on to cooperative society, which is 115 BAD, and then 115 BAE. Same rules as 115 BAA and 115 BAB. No change in the rules. No change in the rules. Expect a question on 115 BAA and BAB in your compulsory question. They can give you a question where they can come and say, compute tax on this company. Compute tax on this company under the special tax regimes. Under the special tax regimes of Taxation Amendment Act 2019. Taxation Amendment Act 2019, which is nothing but BAA and BAB. It's nothing but BAA and BAB. For a company people, that is what they'll use. They'll say compute tax under the special rules of Taxation Amendment Act 2019. When it comes to individuals, they'll say compute tax as per default regime, or compute tax assuming he has opted out of default tax regime. That is what will happen. That is what will happen. Yes or no? Yes. In the recent past, I've been noticing people, past 3 attempts, they have only been testing compulsory questions for special regimes. They have moved out of alternate regimes, and therefore special regimes have become more critical. To know what incomes to be claimed and to know what incomes to be removed is what you need to discuss. We will discuss as we progress in the subsequent topics. Yes, 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 yes. Great. If you're moving from here people, you have something called unexplained income. Unexplained income, very standardly straightforward. I came and told you, tax at the rate of 60 plus 25 plus 4, which is effectively 78%. Nothing to be discussed in this chapter. The only thing to be kept in mind is exam will come and tell you assessing officer has asked for the source of the money or investment or cash or expenses. If you have explained the source, good for you. If you don't explain the source, or if you explain the source and he is not satisfied, it will be treated as unexplained income. No expenses against this unexplained income, no deductions against this unexplained income, no losses, no deduction, no set off, no nothing. Take the money directly. 78% tax will happen on it. Types of unexplained income: cash credits, unexplained investments, unexplained money, partial disclosures, unexplained expenditures, and finally amount borrowed and repaid on hundi. To be noted here people, that when it comes to unexplained cash, officer may ask you for the source of not just yours but also your partner's but also your partners. If assessing officer asks you the source of your partners and you are not able to explain the source of their money, you will also be taxable for that money. You can eventually collect it back from the partners, but you will have to pay the first tax on this. Yes, so you are just not responsible for your own source, you're also responsible for your owner's sources. You're responsible for your owner's sources. Owner's sources can be in the form of partner in a partnership firm or a shareholder in closely held companies, not in widely held companies, people, only closely held companies. Yes, sir. Yes, yes, yes. Next, people, we had something called as agricultural income. Two rules to be kept in mind when it comes to agricultural income. Agricultural income is exempt, but agricultural tax is partially integrated. Agricultural tax is partially integrated. How do you treat something as agricultural income, people? The income should come from a rural agricultural land situated in India. From a rural agricultural land situated in India. How does a land become a rural agricultural land, people? If the land is within the municipality, population should be less than 10,000. If the land is within 2 kilometers, population should be less than 10,000. If the land is between 6 kilometers, if it is between 6 kilometers, the population should be less than 1 lakh. And if it is between 8 kilometers, then it should be less than 10 lakhs. If it is going beyond 8 kilometers, it is always rural. If your population increases these numbers, then it is urban agricultural land. Rules to be kept in mind. Rule number 1, land should be in India for it to be exempt. Second, the incomes which will be exempt are only those incomes which are coming from the land. Any activity which is done post completion of the land, if it is not important for you to sell the produce, then it is a business income. If it is an activity required for you to sell the crops, then it is agricultural income. Even renting of land is called agricultural income, as long as the land is used for agricultural operations. Yes or no? Yes. Only one exception to this rule, people. They've come and said if there is a seedlings and saplings growing in a nursery, then it is agricultural income, even if the operations are not carried out on a land. Any kind of incomes which you have, people, if they are composite in nature, meaning it has components of both business and agricultural, rules are very simple. You have to follow process costing. Split your incomes into two: incomes from factory, incomes from agriculture. In factory, you will show the sale value of the final product minus further processing cost. In factory, you will show cost of cultivation, sale value of cultivation, and cost of the agricultural produce will be treated as FMV of the agricultural produce. You can find out your agricultural income and your business income. But 3 crops, people, for which they have told this is not possible. Crop number one, rubber and latex, where they have told 35% will be treated as PGBP income, 65 will be treated as agricultural income. If it comes to coffee, check for 2 words or 4 words. 2 words becomes 25, 75, 4 words become 40, 60. If it is tea business, again it is 40, 60. 2 words, people. Doesn't matter, forget it off. If you want to know, it's grow and cure, then it is grow, cure, roast and ground. That is what the rules are. When it comes to partial integration, people, the rule is very simple. How do you do partial integration? Step number 1, take your total income plus agricultural income and compute tax. Rule number 2, take basic exemption limit plus agricultural income and compute tax. Rule number 3 is 1 minus 2. You can do this and then add cess, or you can add cess and then remove whatever it is. The answer will remain the same. This is how partial integration will happen. We discussed partial integration, people. I came and clarified partial integration will not happen when the person does not have basic exemption limit. Partial integration will not happen when the income is less than 5,000 rupees for agriculture. Partial integration will not happen when the taxable income is less than basic exemption limit. And partial integration does not make sense when adding the partial integration will not move you to the next slab. Because then also your tax will remain the same. In all those cases, you can choose to exempt partial integration as it is, and you can directly compute tax on the whole number as it is. On the whole number as it is. Yes or no? Yes or no? This is your partial integration concept of agricultural income. Any doubts till here? Are we clear? Yes, yes. Before I move forward to your heads of income, people, some things which we discussed when it comes to heads of income, two chapters which are not part of CA final syllabus but are still to be kept from double taxation relief. First is salaries and the next is HP. Only some things to be kept in mind from salaries perspective, people. Rule number one, when it comes to salary, you get a standard deduction of 50,000 in alternate regime, 75,000 in default regime. To be granted standard deduction only when the question says salary is received or salary is given in months. Salary is given in months. If the question says salary is computed or income from salary, it is assumed that standard deduction is already granted. Be careful, people. If you get a question in exam which says salary computed as per alternate regime, salary computed as per alternate regime, and the question says compute tax as per default regime, you will then claim extra 25,000 to move it to default regime. That is the only difference you need to keep in mind. Yes. Second thing, people, if you have paid any professional tax, you can claim the professional tax as a deduction, whether it is paid by you or paid by employer only under alternate tax regime. Default tax regime, you cannot claim the deduction. That is the two rules which we discussed when it comes to salaries. Yes or no? Yes. When it comes to HP, people, the rule was very simple. We discussed the format. Three kinds of properties you can have: SOP, LOP, DLOP. When it comes to SOP, people, rule is very simple. You directly take the interest on loan eligible as a loss for a maximum of 2 lakhs, subject to some rules that the loan should be taken after 1999. Loan should be taken for purchase or construction of the house. House should be completed within 5 years. If conditions are not satisfied, you can get a deduction of 30,000 rupees. This will only be granted if you are under alternate tax regime. Cannot claim under default tax regime. Under LOP, no such conditions. Under LOP, the format is start with gross annual value minus municipal tax only if paid by the owner, arrive at NAV, reduce 30% standard deduction, reduce interest on loan from anything, whether it is satisfying conditions or not satisfying conditions. All interest on loan can be claimed as deduction. You will end up in a total income. If you have any losses under HP, SOP loss can be set off against LOP income. If not eligible, you can set off against any head up to a limit of 2 lakhs. If you're not able to do that, also you can carry forward. But if you are under default regime, SOP cannot have a loss. Any loss from LOP can only be set off against LOP income. If you're not able to set off against LOP income, you will lapse it off. We discussed, people, ICI has taken a turn on this and ICI has come and clarified any loss from HP only has to be set off in the current year. Losses after this will get permanently lapsed. No carry forward on losses. When it comes to default tax regime under HP. I made you write this under default tax regime, people. Check very carefully. 115 BSc we wrote this. Yes, did we write? Yes, page number. People, default tax regime 115 BSc 33. Yes, something 32, 33, people. In 115 BSc, if you notice, last there will be something called carry forward and set off of losses. Under carry forward and set off of losses, I would have asked you to write down, people. Yes, I would have told you to write down that when it comes to HP losses, this cannot be carried forward. In case you have not written that, please note down, people. You should have made that note already. Yes, I think my book will also have it. Yes, any losses under the head house property cannot be set off against any other head of income. If at all these losses are not claimable, then it is deemed that the losses have been given full effect to, which means they also cannot be carried forward. Please mark this as important for a double taxation relief question. for a double taxation relief question. Yes or no? It's there in this, it's not in your edition, but you would have written it down. Yes, if you have written it down, that's good enough for you. Clear, everyone? Yes, this is your salaries and HP. This is your salaries and HP. Any doubts till here? Are we good to go? Yes, let's take 5.